Good morning, everybody. Yeah, we are once more here and preparing ourselves to take reading as we have been doing for the past few days. Good morning, everybody. Today, we are going to take our lesson from one of our professional books that we have written, and then we shall concentrate on learning or knowing about capital adequacy of financial institutions. Mostly is capital adequacy of banks, but this also applies to other financial institutions which are regulated by the central bank or other analogous institutions. So we shall be taking reading from one of our books, and today we shall concentrate on a reading from this book, the microfinance textbook. This book addresses all things that you want to know or learn about banking and finance. And therefore, today, as you can see, the size of the book is about 375 pages, full of lessons on banking, finance, risk management, and the rest. So we shall be reading one of the chapters, and this chapter focuses on capital adequacy. What really is capital adequacy? This is what we are going to look at today. But before we do, as usual, we are going to take uh, just one music, and we shall listen to a classical music this time for the first time in our presentation. So we shall play music by Handel, and then this music is called Air, water music, Air. So let's listen to it. This is meant to calm all the nerves as we want to take a professional reading today. So get yourself prepared, get your pen, pencil, and paper in order to take some notes. Today we shall be looking at page 37 of this book, and then the title is Capital Adequacy of Banks and MFIs. And then we shall go through the Basel Committee, how it was set up, and the development into the setup of this ratio, which helps the banks to know their level of, yeah. Are you getting ready? Good, good, good. So once more, good morning. And then we are looking at capital adequacy ratio of the banks. So what is capital adequacy? But before we go into that, let's look at one reading from the Bible. Let's read. We shall go to Proverbs chapter 4, verse 7, which actually is the theme for all that we do over here. That is the theme. So wisdom is the principal theme. Therefore, get wisdom. And with all thy getting, or you can say, with all your getting, get understanding. Wisdom is the principal theme. Therefore, get wisdom. And in all your getting, get understanding. Wow. So what are we saying? In everything that you do, whatever you intend to do, try to get wisdom. And in all your getting, that is everything that you desire to have, make sure that you get what? Understanding. Therefore, today we are going to gain some understanding of something otherwise that is difficult for you to understand. We are going to gain some understanding. Thank you. Okay, so we are going to start now. We are going to our book, and then we are going to chapter 37 of this book. Today we are reading the microfinance textbook, and we are going to start. Okay, so get ready. We have now come to the technical stage of the microfinance topics. One of the key issues in banking and microfinance is that the institutions must have sufficient capital to operate. In this chapter, we shall look at the capital of these institutions and how the regulators assess them. We shall look at the historical development of Basel Institute, which sets standards for banks and financial institutions mainly on risk management starting from 1974 till date. So this is the introduction, and then we are looking at Basel. You can also say Basel Institute, depending on how you pronounce it, and how they set these standards, or how it means, what is the meaning of this standard for us who works in financial institutions, whether you are a banking student or a banker or working in the microfinance sector. We normally talk about our capital adequacy. How is this measured, and what is the formula, and how can you apply it to yourself? Then we shall go on to find out also why should some institutions, some financial institutions do fail, and the reason why they fail, they are all stated in this book. So let's look at the historical development. Historical development. Basel is a city in Switzerland. In 1974, all G10 countries' central bank governors met in Basel in order to see how banking could be improved through a common guidance. Various policies were developed since then, but the most important one became operational in 1988, which is called Basel I Capital Accord. Basel II Capital Accord was later developed in 2006 after a series of revisions. Basel II is actually the basis of capital adequacy for all banks. Later, improvements were added, and Basel III came up in 2010. And the central or reserve banks around the world are expected to implement the changes between 2013 and 2015 in their respective countries. However, an extension was granted for full convergence till 31st March 2019. So this is the historical development of Basel Institute in having what we call Basel I and then Basel II Capital Accord, and then the various timelines that have been described. So now let's go on and look at what are we talking about here as capital adequacy. What is capital adequacy? Capital adequacy is the statutory minimum reserves of capital which a bank or other financial institution must have available. That's the definition, but we are going to go on for to explain it further. Under Basel III, the minimum capital adequacy ratio that banks must maintain is 8%. The capital adequacy ratio measures the bank's capital in relation to its risk-weighted assets. The capital to risk-weighted assets ratio promotes financial stability and efficiency in economic systems throughout the world. Capital Adequacy Ratio, or CAR, is defined as, so we are going to give the definition to how the measurement is. Capital Adequacy Ratio, that is CAR. So we from now on we can say CAR is equal to Tier 1 capital plus Tier 2 capital, all divided by risk-weighted assets. So Tier 1 capital plus Tier 2 capital, then you have a total. Then all will be divided by what? Risk-weighted assets. So this definition helps us to understand how the measurement is. And then this measurement, you must always have a minimum of what? 8%. A minimum of 8%. And then various countries either chose or adopted this exactly at 8%, or others have also increased it to maybe 9%, 10%, depending on the risk management directives of the central banks. I know, for example, in Ghana, the Banking Act 2016 put this ratio at 10%. So the banks in Ghana must have a capital adequacy ratio of 10. Other countries have various rates, but the minimum is 8%. So, but let's see what is Tier 1 capital and also what is Tier 2 capital. Then we'll also look at the risk-weighted assets, how they are constituted. So number one, Tier 1 capital is equal to paid up capital plus statutory reserves plus disclosed free reserves minus the equity investment in subsidiary plus intangible assets plus current assets and brought forward losses. It's a broad definition. But I know some of our banking finance students will understand what we mean over here. So over here, Tier 1 capital is what? Paid up capital and statutory reserves plus disclosed reserves. Okay? Minus the equity investment in subsidiary plus any intangible asset plus current and brought forward losses. So let's break it down one by one. So the paid up capital of the bank or the financial institution plus any reserves, for example, any retained earnings for the period. Let's say for the previous years, like year 1, year 2, year 3, that you have made some profit, they all constitute what we call the reserves. Sometimes we also call them retained earnings. That is what we have. Then if you have other investments in any subsidiary, and then you also have some intangible assets like goodwill and things like that, these must be subtracted from this figure. And this is what if you have some losses also brought forward, it must be subtracted. If you have those things, then you arrive at what we call Tier 1 capital. That is a measurement, Tier 1 capital. Now let's look at Tier 2. Tier 2 capital is undisclosed reserves and general loan loss reserves, plus hybrid debt capital instruments and subordinated debts. Majority of the cases we apply the loan loss reserves. The loan loss reserves is what? The reserves that we set aside towards our provision, the loan loss provisions reserves. And then if you also have some hybrid debt capital instruments or some subordinated debts, for example, you have pledged some of your assets towards some loans. See, those ones will also be added over here. And other elements, the hybrid debt capital instruments. Okay, so some securities on the asset and the rest, they will form part of what we call the Tier 2 capital. So Tier 2 capital is not as big, or is not as in terms of size, is not as big as the Tier 1 capital. The Tier 1 is your paid up capital, so which means that it is the bigger part of than the Tier 2. is what we have looked at. So we can look at some of the examples of a tier 1 type, which is already given, but the tier 2, the main thing there is your loan loss reserves. Okay, then you have some hybrid capital instruments, and then also unsubordinated debts that you have taken from other institutions. Okay, so now let's look at 3, which is the risk-weighted assets. After you added the tier 1 and tier 2, you arrive at what then you have to divide by the risk-weighted assets. So the risk-weighted asset refers to the fund-based assets such as cash, loans, investments, and other assets. They are the total assets owned by the bank. However, the value of each asset is assigned a risk weight. For example, 100% for corporate loans, 70% for mortgage loans, 60% for non-collateral loans, and the credit equivalent amount of all off-balance sheet activities. Each credit equivalent amount is also assigned a risk weight. Are we getting it? So when we talk about your risk-weighted asset, basically it is your total assets. But because in one of our biggest assets in financial institutions is our loan portfolio, this loan portfolio must be assigned some weight. So based on this, maybe the type of loan that you have, one is more riskier than the other. For example, if you are giving out group loans in a microfinance, it is less riskier than when you give out individual loans. So each of these will have different weights. Then these weights will be calculated, and then you arrive at the total. That is why it is called risk-weighted assets. So after you arrive at this figure, then this total figure will be divided. You used to divide the tier 1 and tier 2 capital. Then you arrive at a certain percentage. This percentage that you arrive at must be more than 8%. That is the minimum is 8%. That is what we are saying. And therefore, if any institution has less than that, that means that the company or the bank or the institution is suffering from what we call capital adequacy. It means it doesn't have sufficient capital to meet the requirements of the regulator. I remember in a few years back, some of the financial institutions were closed down in some countries. It is because they failed to meet the capital requirements of the central bank. So they were not able to achieve what was set as a standard for them. So that is why they have to be closed down, or they were asked to regulate and make sure that they meet the requirements, but they were not able to. So we know the challenges that come. Either they merged into other institutions, or they were taken over by other financial institutions, or they were forced to close down, so to speak. But we are going to look at some of the challenges that some of the financial institutions face, and then we'll see how best we can address them. But before we do that, we are going to take a break, and then we are going to pray. We'll play one music, the Swan, which is called the Carnival of the Animals by Saint Sian. So listen. Okay, that is the Carnival of the Animals by Saint Cyr. Its title is The Swan. Today we are not looking at any spiritual part of our books. Otherwise, I would have liked to explain what the swan stands for. But another occasion we will explain the eyesal of swans. Okay, great. So we can continue our reading, but we have a further reading on the Basel 3, which is more detailed in the chapter. But we will leave this for those who are still committed to reading more and then continue in the book. And today, if you have just joined us, we are reading from the microfinance textbook, and then we are at page 37, Capital Adequacy. This is what we are reading today. And then we have just looked at the historical development of the Basel Institute, which set the standard for capital adequacy and risk management of the banks and the rest, because it is composed of the governors of the central banks. And then we have looked at Basel 2, Basel 3, and then we have concentrated, or we narrowed down to capital adequacy. And then we also stated that when you do your capital adequacy, the definition says that you must arrive at 8%. And then we broke down the definition into tier 1, tier 2, and then the weighted average asset of the company. So we shall now proceed and look at the subtopic which says what? Why do banks fail or collapse? Why do banks fail or collapse? This also applies to microfinance institutions. Why do they fail sometimes? Apart from COVID, which has come as a new thing that has destroyed many other things for financial institutions especially. So let's look at what has been penned down about 4 years ago. This book was written in 2017. Okay. So from the aforementioned, you will see that for the bank to fail, its capital will be less than 8% set. In other words, the following could lead to the result of its CAR being less than 8%. 1. High defaults on loan. Many banks take more than expected risks by lending to clients or sectors that are considered risky. In other words, they are not able to recover their loans, leading to high provision for loan losses and later write-off of those loans. When this happens, its capital adequacy drops to a lower level as its capital has eroded by these write-offs. You see, the number one, the main thing that happened to most financial institutions is that they face challenges of recoveries. That is to recover the money that they have lent to their clients. They are not able to recover the money. And therefore, they have to do big provisions, loan loss provision, and later on, a big write-off. And therefore, this affects the bottom line, the profitability, and therefore, it also affects the capital adequacy of the company. And therefore, the ratio definitely will also be affected. Let's look at reason number 2. diversion of clients' deposits. Diversion of clients' deposits. The majority of the financial institutions are in the habit of diverting client deposits into other long-term fixed assets. You will see that most of the financial institutions have a construction or property development subsidiaries. Client deposits are used to finance those projects. Now, when the clients come to demand their deposits, they do not have the cash available since it is locked up in the property development projects. Wow, very simple. The client's deposits are supposed to be put in a liquid asset. You can put it in other investments with other banks, which will be liquid, so that when clients are ready to draw down on their deposits, you should be able to meet them. But what we see is that most financial institutions, they open what we call construction companies or maybe real estate companies, and then they channel most of the client deposit into these projects. And therefore, construction or real estate consumes a lot of funds. But when the clients come for their deposits, they are not able to meet the, the demands of the depositors. Okay, high operating costs. High operating costs. That's number three. The majority of the financial institutions hire a number of staff that are not productive. To demonstrate that they are doing well, much money is invested into advertising, uniforms, branding, and image building. At long last, this all leads to high operating costs that eat up the profit and later eat up client deposit, as in number two above. You see, high operating costs. Some of the financial institutions in some of the countries that I work in are always on show. They are in flashy cars, nice dress. They are always doing promotions in the media, either on radio or television or the rest. Always on the promotion. Too much promotion eats up their capital because it's a high cost for some of those promotions and advertisement that they have been doing. Okay. And then number four is high staff turnover. High staff turnover. Most experienced hands often resign and go to other financial institutions. There is a loss of institutional memory, and the procedures and policies are not followed as it should be. Yes, as the company is having distress or having challenges, some of the experienced hands do resign and move to other institutions. And therefore, the institutions suffer from what we call the institutional memory. So they are not able to get right-minded people that will carry out the vision, the mission of the organization. And therefore, this also affects the performance of the said financial institution. Now, let's look at what can the central banks do. Now, what will the central bank do if the financial institution is under distress? What do the central banks do? That is to salvage the situation or to at least to be able to come in to help. Let's look at what they do. The central bank will come with a number of suggestions to the financial institutions. It shall actually give it a deadline to address its capital adequacy issue or face revocation of its banking license. The following are done by the central bank. So we are going to look at the points what are the things that the central bank can do to help the financial institutions that are in distress. Number one, ask the board of directors of the bank to increase its capital base in order to absorb the losses quickly. This could be done with injection of fresh capital, which may mean taking a new strategic partners if the existing shareholders cannot inject more capital. So the central bank will, the first thing that they will do is to ask the current shareholders or the directors to inject new capital into the business in order to meet the capital adequacy shortfall. If they are not able to do it within themselves, then they must take on new strategic partners, maybe new investors that will pump in new shares. Okay, number two. Without one above, which we have read already, the smoothest process is to allow another bank, which is more liquid and is of good standing, to take over the bank, which is in distress. An example is what happened in Ghana in early August 2017, where two banks were taken over by the oldest commercial bank in that country. So we have one example over there. So the central bank will force the distressed bank to be taken over by another bank which is more resourceful, so that they will be able to continue operation. But this time around, the shareholders have taken the new bank has taken over the shares of the company and the rest. Let's look at number three. What will the central bank do again? The bank will also be liquidated completely by appointing an official liquidator. The liquidator will sell the liquidating bank's asset in order to defray the losses incurred. This last option normally causes hardships to depositors, who will have to wait for all the assets of the bank to be sold before they get their deposit back. Wow. Okay, so let's look at the conclusion. Conclusion. Banks should concentrate on their core mandates instead of diverting client deposits into construction, property development, and fixed asset acquisitions. They should also stop the flamboyant lifestyle as displayed by many banks and savings and loans companies in countries I was permitted to work. By this, they will be able to maintain a good capital adequacy ratio and continue to be in business. So this book, to know why it is doing very well in the market, even on Amazon, get your copy. Everything about banking, microfinance is stated in the risk management aspect are all in this book. And therefore, we are going to show you other books that we have, and which we have been, anyway, for most of you who have been joining us, you might have seen them already. And we will also tell you where you can get them so that you will be able to gain a lot of knowledge. As we said from the beginning of our design, the principal thing is what? To get wisdom. And in all you're getting, get what? Understanding. Therefore, we have the 18 laws of personal development. We have read 2 chapters from it the previous time. We also have the Embattled Earth, and then we read 1 chapter last week from it. We have the Embattled Earth, which is the spiritual book guiding your spirit into understanding of things that is to come, and then things that are happening and why they are happening now, and how you can adjust yourself to these things. And then this is the one from which we have just read, the Capital Adequacy. So this book is a professional book for bankers, microfinance, and then accounting students, as well as the practitioners. So for all these books, you can get them on Amazon, wherever you are. You can get all these books to buy on Amazon. Just go into Amazon and then look for Siegfried Silverman, and then you will be directed to all our books that are in publication over there. And then also, depending on where you are, in case you are in Myanmar, you can go to any of the bookshops. Several bookshops are selling all our books, and then you can get them wherever, whichever bookshops that you uh, in Myanmar, you can get them. In Ghana, you can go to Legon Bookshop and also EPP bookshops. And also we have the microfinance textbook at Chartered Institute of Bankers, which is at East Legon. And we also have an agent. When you contact us, we can give you the person's contact. Then you can get some of the books that might not be in the bookshops. In Malawi, you can go to Claim a Book, and then you'll be able to get the books from there. In India, you can also go to Amazon India or Flipkart, and then you'll be able to get our books. So thank you very much for joining us today, and hopefully next week we will take another reading, and then we will see how best we can continue getting wisdom, getting knowledge, because that is the key thing in development of ourselves. Thank you very much for joining us. Bye-bye.